let's get started again. So you'll recall on Tuesday, we talked about bonds, we talked about bond prices and the relationship between bond prices and interest rates, and stopped at the point where we briefly said, well, okay, since we do everything with money in a monetary economy, we do lending and borrowing with money too, but in the end, when we are doing transactions over time, inflation confounds things. So money doesn't have the same purchasing power. The same purchasing power doesn't mean the same thing to you either, right? Because you are different over time as well. But even before then, it's important to recognize that 100 liras that you're going to lend out today, and you'll be paid back as 105 liras a year from now, right, might actually imply a lower purchasing power. And that was the idea that, so I have to learn to use this better. Let me get this. You are the guinea pigs of the first lecture with, there we go, a microphone. And do let me know if things don't work. How about that? Okay, very good. Is it just better or is it good? All right, I'll take that as go ahead with this. So we have, recall, interest rates in money terms, and those we call, obviously, nominal interest rates, okay? And we have the change in the purchasing power implied by this. And those we call the real interest rates. And what would these be in Turkish? Yes, one of them is reel faiz. Real interest rates are reel faiz. And the other one is nominal faiz. Okay, good. And the thing that relates nominal interest rates to real interest rates is inflation, okay? So we're going to denote nominal interest rates with I, real interest rates with R, and inflation with pi, and the relationship is 1 plus I. This is 1 plus I because this I, if it's 10%, is going to be 0.1, okay? And therefore, the total payment at the end of the period is the principal, 1, plus the interest you receive, and that's going to equal the principal in terms of the purchasing power plus the real interest rate times, you will recognize this as the new price level, right? This is the inflation rate. This is where we started from. This is where we ended up in the price level, okay? This is a nonlinear relationship, and nonlinear stuff are not the most pleasant things to work with, especially when you're trying to do mental calculations. So you can approximate this with a Taylor series approximation that you learned in calculus, and you would end up with an approximation around 0 for I, R, and pi. You will end up at that. Okay? Effectively, and you didn't need me to teach this to you, the gut feeling that you have is correct. If the interest rate is 10% and inflation is 6%, okay, the change in the purchasing power, the real interest rate is, I'll let you answer. Any other takers? I am happy to do a course with Mert Bey alone, but he seems to be the only one answering my questions, and that won't do. Yeah, okay. The real interest rate is going to be 4%, all right? Now, we have two ways of thinking of the real interest rate. For the nominal interest rate, the money interest rate, it doesn't matter whether I look at this at the time I make the loan or at the time I'm paid back, right? If we agreed that you're going to pay me 125 liras as interest at the beginning of the lending borrowing agreement, you're obliged to pay me 125 liras with respect which represents, let's say, 12.5% interest. Okay? At the end of the period, when you do pay me 125 liras, you have paid me 12.5% interest. Okay? So, you know, on a timeline, if this is date 0 and this is date 1, right, the nominal interest rate is the same. You're going to pay me this many liras, and it's going to represent this percentage interest. If I think of this here, it's the same interest. If I think of this there, it's the same interest. For the real interest rate, though, it's different. Okay? This is where we begin to think about the difference between ex ante rates and ex post rates. Ex ante means before the event. Okay? You may have heard the phrase ante-room. Okay? Ex post, properly ex post factum, is after the event. Ex post factum is after the fact, after the thing is realized, known. Okay? What is the thing to be known? It's inflation. That's what we don't know, right? At time 0, you make me a loan at the interest rate, the nominal interest rate of I. You expect a real interest rate of R. Notice that you know the nominal interest rate, you expect the real interest rate. Why? Well, because the lending and borrowing agreement specifies what the interest rate is or what the interest amount is, right? If you bought my 1,000 lira face value bond for 800 liras, you know that you're going to get 200 liras of interest income, and you know that that represents a 25%. 200 is 25% of 800, 25% interest rate. Okay? At the end of the period, when I pay you back, you will be paid exactly what you thought you would be. However, when making this loan, when buying this at 800 liras, you had in mind that inflation will likely be, let's say, 10%. Did you know that inflation will surely be 10%? No, you did not. Okay? You had expected it, right? That's the ex ante idea. Before the fact, because somewhere here, right, inflation will be realized. On the time I make you the payment, you will know how much real interest you get. That's the ex post, right? So ex ante, you thought inflation will be 10%. And let's say inflation turned out to be exactly 10%. Okay? What is the ex post real interest rate? Shall I yo you? Okay, very good. Nonetheless, yo, wake up. Yes, it is 10%. Good. I am very much hopeful that you are all able to do the math that if nominal interest rate is 20 and inflation is 10, then the real interest rate will be 10. And if not, go back to primary school. Now, what happens if your expectation of inflation turns out to be wrong? Okay? Assume that you are the lender and I am the borrower. You lent to me at 20% interest and I borrowed from you at 20% interest, with us all assuming, all expecting inflation will be 10%, all right? Inflation turns out to be 5%. What happens to the real interest rate that you are receiving? Yeah, very good, and thank you for the responsiveness. It goes up to 15%. You are now receiving a higher purchasing power. I am now transferring you more real resources, more purchasing power in terms of the real interest rate, because inflation turned out to be lower than expected. Okay? Who is happy? Are you happy or am I happy? That's right. Yo. No, I am not. Okay. So most of you got it right. Okay. But a few of you said, I am happy. I am not. I am the borrower. I borrowed thinking that, oh yes, I'm going to give you 120 liras at the end of the year. Right? But 10 of these, of the extra 20, 10 of it will be eaten away by inflation anyway. So I'll really be giving you 10 more potatoes, not 20 more potatoes. Right? But inflation turned out to be 5%, so I ended up giving you 15 more potatoes. I am not happy. You are happy. Okay? Whoever said you to my earlier question, are you okay with this? Don't make me scroll up. Okay, very good. Now, what happens if inflation turns out to be not 10%, but 20%? What happens to the real interest rate now? Yeah, very good. Good math. All right. What happens if it goes to 30%? Could happen. No? We agree ex ante on a nominal interest rate of 20, inflation goes up to be 30. What is the real interest rate? Very good. It's minus 10%. Who's happy now? Yeah, yeah. Okay. So now understand that therefore, not expected inflation, right? Because if we expected higher inflation, then we would have contracted on a higher nominal interest rate already. Okay. But surprise inflation redistributes real funds from lenders to borrowers. This is something important to know, right? Cool. Let's now talk about this. We talked about part of this last lecture where we said, can the nominal interest rate be negative? Okay, in the real world, we have seen the nominal interest rate be negative. You win, fine. Yes, like Germany, very good. But for a moment, could we stick to our theoretical framework? Okay, and then because that's the only way we talk about why what we're seeing now is an exception, is surprising. All right, would you lend me 100 liras today to be paid back 90 liras a year from now? Notice that we already talked, this has nothing to do with deflation, right? 100 liras a year from now will always be more than 90 liras a year from now, okay? Thus, you will never agree to lend at negative interest rates. Are we good? Cool. All right. Now, that begs the question, and you are right, Germany is borrowing at the 10-year maturity on an annualized basis, that is a per year basis, at minus 30 basis points, minus 0.3%. Okay? So how is that possible? How is it that a lot of central banks around the world, Japan, Switzerland, whatever, Switzerland has minus 75 basis point policy rate? Okay? That is 0.75% negative rates. How is that possible? Okay? We thought this would be impossible. But after the global financial crisis, with the ensuing recession and the deflation threats and whatnot, central banks essentially experimented and said, what happens if we do this? And they could. Here's why. Remember our discussion of the birth of banking. At the very beginning, banks were there to safekeep your money. You need somewhere to put your gold. You need somewhere to put your cash, okay? And banking, therefore, sells you a convenience service that keeps your money safe. You don't have to stay awake thinking, what happens if burglars come into my house or burglars come into my bank in this case? It's a service for banks too, because central banks keep commercial banks' reserves, okay? Could you charge for this privilege in terms of small negative interest rates? All right? Would you rather sit on your wealth in nominal terms, or would you rather keep it safe with me, but I will pay you a small negative interest? Essentially, you will pay me for this, okay? Yeah, okay, so you could. This is why what we used to call the zero lower bound turned out to be not at zero, okay? Many people now call this the effective lower bound, meaning, yes, interest rates can get a negative a little bit, okay? Switzerland was able to do minus 75 basis points. Recall that 1 basis point is 1/100th of a percentage point. That is, 100 basis points are 1%, okay? But when Switzerland went to minus 75 basis point policy rate, when the central bank said, and we haven't talked about these yet, when the central bank said, okay, you can give your excess reserves to me, but you're going to get minus 75 basis points interest on that, okay? the Swiss banks began to mumble, well, maybe we're going to build vaults. Maybe we're going to keep it as cash. Minus 75 basis points is actually too much of a loss. Okay, and the central bank said, you know, we really don't want you to do that, and we'll find ways of gently punishing you if you were to take that route. So accept the minus 75 basis points. All right, but it has to be clear to you that minus 75 basis points, it hardly may be done. Minus 1%, maybe, but no one has dared, right? Clearly, you can't go to minus 5% without people saying, you know, screw your bank, screw your loan, okay? I'm gonna keep the cash as cash, all right? There is a lower bound. Good? Okay, so you will see almost everywhere this thing being called the zero lower bound, okay? Understand that we now understand it's not exactly at zero. Small negative kind of works. But now let's talk about real interest rates. You've already seen that ex-post real interest rates can easily be negative. If inflation turns out to be much higher than expected, of course, the real interest rate is going to be negative, right? Cool. How about the ex-ante real interest rate? Can that be negative? If we all thought inflation will be 10%, would you lend me at 8%? All right. No is a very good wrong answer, my friends. Let me ask you this question now. Let's pick on Cemre Hanım, I guess. Are you there? All right, very good. Now, you have two alternatives, okay? Either you're going to lend to me or you're going to keep your cash. You think that inflation will be 10%, right? You have 100 liras. So you could lend me at 8%. And at the end of the year, you'll have a 108 liras, okay? And the price level will have gone up by 10%. Or you won't lend me. You will still have 100 liras, and the price level will have gone up by 10% again. Which one is better? Do you all see this, right? Cemre Hanım immediately got the point that 108 liras a year from now is more than 100 liras a year from now, regardless of what inflation we expect, okay? Are we okay with this? I am. Are you okay with this now? Cool. All right. Thus, in real interest rates, ex-post real interest rates can be negative. Ex-ante real interest rates can also be negative. You will talk with Burçin Hoca deeply about monetary policy, but with monetary policy, real interest rates go to negative territory very often. Okay. In fact, depending on how you look and what your inflation expectations are, real interest rates in Turkey are negative right now, which is a colossal policy mistake, but they are, okay? Our central bank now has a policy rate of, I think, 9.25%, okay? And inflation is 12, and expected inflation is in double digits, okay? So clearly, the ex-ante real interest rate is negative already in the country you're living in, okay? Now, do me a favor, could someone check what the latest policy rate of the central bank is, so that if I embarrass myself, I can at least correct it? I can do that myself too. And meanwhile, talk with you. No, I can't do these two things simultaneously. So give me a moment. 975. All right, I'll take your word for that. Good. My general point remains. My embarrassment for misreporting the policy rate also remains. We have expected negative real rates in Turkey now, okay? Can it happen? Not only it can happen, it does happen. And it happens fairly often, all right? Cool. Now let's think about bonds a little bit more, okay? A bond, we already said, is a promise for a future payment. Let me ask you now, do you remember this? This is kind of an insulting question. Let me not ask this. Of course you remember it. Okay? So we said a bond is a piece of paper that looks something like this, right? 1,000 liras promised on good. And you're going to buy this at most for how many liras? Yeah, exactly. At most, you're going to buy this for 1,000 liras, okay? Unless the nominal interest rate is negative. And you're buying this at a price lower than its face value. This is called the face value, because that's the way you receive interest, okay? This kind of a bond is known as a discount bond. Türkçesi iskontolu. A discount bond is a promise for one single payment in the future that you buy for a price that is less than the promised payment. That is, you buy this future 1,000 liras at a discount so that you receive interest. Okay? Cool. In Turkey, we issue these discount bonds, iskontolu senet, iskontolu bono, up to a maturity of 2 years. In the US, these things are issued up to a maturity of 1 year. However, when the maturity gets longer, issuing these things become iffier. Because think for yourself, right? I tell you that I'd like to borrow from you for 10 years. So buy my 10-year maturity notes, okay? So this is now 2021. Now this is correct. Yes, somebody had already corrected me. Thank you for that. Rather than 2021, this is, let's say, 2030, okay? Give me 1,000 liras now, I'll pay you back 10 years from now. And this proposal of give me your money now, and you're not going to see anything for 10 years. You're not going to receive any cash flow for 10 years, doesn't sit well with people most of the time, okay? One is because people want these cash flows. The other one is because, really for the same reason, when those of your economists study more finance, you're going to learn this bond, in that case, will have too long a duration, which is a problem, okay? So what happens is, I tell you this, how about this one? Let me attach little coupons to this thing, okay? So I'm going to make this a 2-year security now. It's going to pay off in 2 years. But on 26th of, it's going to be September 2020, okay? Let's say this is 5%, and then 26, 1, another 5%, and so on, okay? This part, this is perforated. You can tear it or you can cut it, and you can bring this little bit piece of paper to me, okay? On this date, 6 months from now, and get a payment on that date as well, all right? These little pieces here are called coupons, and this whole thing is called a coupon bond now. So here's what happens. If this says 5% coupon, it means 5% of this amount, the face value, per year. Thus, since this thing pays 2 coupons per year, okay, I would call this a biannual coupon bond. Since this pays 2 coupons per year, it's going to pay me 5% of the 1,000 as the sum of the 2 coupons. How much is it going to pay me on the first coupon date? Do the math. Do the math. Yes, I can see that you are confused. Stop it. Yes, all right. The coupon rate, this 5%, is a percent of the face value, okay? So let me make this easier. What is 5% of 1,000? It's 50, that's right. But it's going to pay you 50 over a year, okay? As the sum of the two coupons within the year. So on each one of them, how much is it going to pay you now? It's 25, okay? So you're going to get 25 6 months from now, 25 a year from now, 25 18 months from now, and 1,025 on the maturity date. The last coupon is on the maturity date, okay? Long maturity bonds do have coupons, yes. Okay? Very good. Now notice that. Can the price of this thing, now I'm trying to sell you this, can the price of this be larger than 1,000? Very good. Yes, indeed, right? Because the total cash flow, that's the term, the total cash flow of this is 1,200 liras, right? So the price can be up to 1,200. It could still be less than 1,000, right? If I'm not a very trustworthy borrower, if you think that inflation is going to be very high, if you find that the risk is too much, whatever, right? The price might still be 800, in which case you would be getting an insane return. Notice that this 5% is a completely separate concept than the interest rate you're going to get by buying this bond, okay? 5% coupon rate is what you're going to get as the coupon payments. But the interest rate is still determined by what you pay for this whole basket. I call it a basket because the right way to think of a coupon bond is to see that, look at this one coupon, okay? It says, when you bring this to me, to the issuer, on this future date, you will get 25 liras. It's a promise for 25 liras in the future. Only that one payment on that one date. What is the thing that promises one payment in a future date? It is not the coupon rate. It's the coupon itself. And yes, it is a bond, right? In fact, not any bond. It's a discount bond. This one coupon is a discount bond on itself, right? It promises you one payment on one future date. This is another discount bond. That is another discount bond. That is another discount bond. And the principal is another discount bond, okay? So if I know how to price a discount bond for this date, for that date, for that date, and for that date, I can sum those up and find the price of the coupon bond. And this is exactly how we think of coupon bonds anyway. We think of coupon bonds as baskets of collections of discount bonds, okay? The discount bond is the basic thing. Coupon bonds are really baskets of discount bonds. So it's the discount bond pricing that one has to think about. Okay? In fact, it is possible for me to buy this whole thing, cut the coupons, and sell the coupons to you separately. We can easily have secondary trading of only the coupons or only the principal. In the US, this is done under a program called STRIPS, and it's an acronym for separate trading of interest and principal. All right? You don't have to know this. This is just for the fun of it. Cool. Now, the interest rate, the interest you're going to receive, I could ask you, if you had paid 820 liras for this, what is the interest that you're going to get over the 2 years in annualized terms? Okay? You can calculate that. It's no longer this trivial calculation. It takes a bit of an effort now. Okay? But you can calculate that. And you can get an internal rate of return, a yield for this. Okay? So the interest rates, we call these interest rates yields of bonds. Türkçesi getiri. Bonunun getirisi. Okay? And I can ask the following question. Think of bonds of different maturities. So here I have maturity. And here I have yields. Fidan, yes. Good question. So somebody asked, is there regulation on the rates of coupon bonds, a lower coupon bound or an upper coupon bound? No. It depends on the inflation rate. We talked about this, right? In a higher inflation environment, you would have to offer higher coupon rates, because if I tell you now that, lend me now and I'll pay you 2 liras for the next 5 years, okay, you're going to look at this and say 2 liras doesn't buy me anything. Okay, so a small coupon rate won't quite do it. We think of interest rates, or we talk of interest rates in annualized terms. Yıllıklandırılmış olarak. That is, if this is a 5-year note, and I look at this and say, oh, yes, the yield is 8%, it means it's 8% per year, okay? Cool. And that's what makes different bonds compatible, because I could now ask, would you rather buy a 1-year note at 11% or a 5-year note at 12%, okay? These are all per year, 11%, 12%, all right? Now, the problem is this. If you buy a 1-year note at the end of the 1 year, you know that you're going to get 11% exactly, okay? Because it's going to mature, it's going to pay back. You know what you're going to get at the end of the year. But assume that you bought the 5-year one at implied 12% interest. Remember that 12% is the result of how much you paid for it, right? You looked at the price and you said, given the cash flows, given the coupon rates and the principal, if I pay this much for this thing today, on an annualized basis, I will be getting 12% per year, okay? Are you sure that you're going to get 12% every year? Could it be the case that you bought this for, let's say, 650 liras today? And when you bought this for 650 liras today, it implied that the yield is 12% per year, okay? A year passed. This bond still has 4 years of maturity, right? You got your coupon payments, but now you need liquidity. You need to sell the bond. You realize that everybody needs liquidity. Everybody is selling the bond. So the bond's price has fallen down to 400 liras, okay? You are not only not getting 12%, regardless of the coupon rate. If the bond price has fallen that much, you are now making a loss. If you have to sell it now, right, you will be selling it at a loss. Do you see that? Okay, that is why long-term bonds involve a greater risk, because if you need to fund this bond by borrowing from money markets in short term, so think that you're borrowing for 1 year, so you think that, we're very smart, so we said, okay, look, here is this bond that pays 12% annualized over 5 years. I can also lend and borrow at 11% at 1 year. So here's what I'm going to do. I'm going to borrow at 11% for 1 year, and I'm going to buy this bond that pays 12%. Okay? At the end of the year, I'm going to borrow again for 1 year. And I'm going to do this essentially 5 times to cover 5 years. Okay? This is a trade. But understand that if at the end of the year, the 1 year interest rate has gone up to 15%, for example, now you are borrowing at 15% to keep your 12% bond. Okay? You're making a loss. That's going to hurt you. All right? So your bond is going to be sold because other people will feel the same way too. Its price will fall so that it also offers a high enough interest rate. Long-term bonds involve a greater market risk than short-term bonds. Therefore, even when we are looking at things in an annualized way, on a comparable basis, the relationship between maturity and yield is usually positive. It's something like this. All right? And if you're interested in this, you can talk to Burçin Hoca. He is the grandmaster of these macrofinance stuff. It's upward sloping for, we think now, because of this risk pricing, all right? But the slope of this thing has information. If the risk weren't priced in, then I would look at prices of long-term bonds, implied yields of long-term bonds, compare them to short-term bonds, and think of the following, okay? This is not something that's going to be on your exam. This is just because you're taking a proper introductory class, okay? I just want to talk about these things because they become topical very quickly. So I would like for you to have a passing affinity with this, but you're not listening to me and trying to learn this for exam purposes now. Imagine that I have a 1 year security and a 2 year security, okay? I see that the 1 year security trades at 10% implied interest, and the 2 year security trades at 15% implied interest, okay? Now, I can think of the following. There are 2 ways of finding funding for 2 years. One is, I'm going to borrow for 2 years. And if I do so, the average interest is 15%. The other one is, I could have done this. Borrow for 1 year now, and also now, today, sign an agreement with a future lender that says that lender is going to lend me in a year's time for a year. So effectively, I can do this. We are at time 0 now, right? This is the end of the first year. This is the end of the second year. One way of doing this is borrow for 2 years, okay? The other one is borrow for 1 year, but also sign a contract now for the second year's borrowing. Fix the interest rate here, okay? So I could ask you this question. Give it a thought for a second. At what interest rate would you agree to lend me, okay, today? So I'm asking the question on March 26, 2020. At what interest rate would you agree to lend me beginning on March 26, 2021 for 1 year? Okay? Can we fix that interest rate now? Can we sign that contract? The answer could be anything, right? But this question does have an answer. We can come to an agreement. It will depend more than anything else on what interest rate we think will be realized here, right? If we think that the interest rate a year from now, the 1 year interest rate a year from now will be 20%, okay? What we're going to sign the contract on will be something close to 20%. It's going to depend on our risk perception and risk pricing. We're going to learn this in later classes, right? But notice that there are 3 things here. The 2 year yield, the 1 year yield, and what is called the 1 year forward 1 year yield. Bir yıl sonraki bir yıllık getiri. Buna Türkçe'de biz ileri valörlü diyoruz. Okay? These contracts actually exist. People do sign them. But more importantly, the concept exists, and I can see this. Look, from our perspective, these two things entail exactly the same cash flows. And therefore, they should have the same price today. Hence, if I know the 2-year yield, and if I know the 1-year yield, okay, knowing that compounding this here should give me the same 2-year yield, I can back out the 1-year forward, 1-year rate. İleri vadeli getiriler, kısa ve uzun vadeli getirilerin kıyaslanmasıyla bulunabilen şeyler. Since I can do that, okay, I can say, ooh, the interest rate now is 10%, and the implied 1-year forward, 1-year rate is 15%. That means, most likely, up to risk premium, people are expecting interest rates to go up next year. Then I ask, when do people expect interest rates to go up? Okay? This question you can't answer yet because we haven't talked about central banking and these things yet. But in general, when inflation is high, central banks raise interest rates. So I can look at this and say, ooh, maybe people expect inflation, okay? Now, every now and then, and this is why I really wanted to talk about this, because this happened very recently, and most likely it's going to happen again. Every now and then, the yield curve looks not like this, but like this, okay? It becomes downward sloping. This is called an inverted yield curve, okay? This one is the normal yield curve. Since we have this in mind in normal times, when we see this, we say it's inverted. And an inverted yield curve signals that people are likely expecting interest rates to go down. When do interest rates go down? Well, central banks cut interest rates in times of recession. Thus, this is a signal that the market participants are expecting a recession. This freaks central bankers out. People like me, Burçin Hoca, we both do similar things. We spend a lot of time trying to understand what moves this yield curve around, how it relates to macroeconomic fundamentals, how we can relate it to, GDP growth, inflation, expected inflation, and things of that sort. Okay? So I hope this was somewhat fun. Once again, if you did not understand this, that's okay. This is not 102 material. If you did get something out of this, hopefully it's going to be useful to you. You know that I send you news from Bloomberg, Financial Times, Wall Street Journal, whatever. So now I will be sending you things along the lines of the yield curve flattened, the yield curve inverted, and you will have an understanding of what that refers to. Are we good? All right, love you all, thank you. Notice that even if you follow this now, it's very difficult to learn these things this fast, okay? So, if in the evening, when talking with your friends, whatever, at home, you want to say something along these lines and you can't put it together, it really isn't your fault, okay? Don't consider this decent teaching. Now, let's spend a few minutes on one more thing about interest rates, money now, money in the future, present values, future values, and then have a break, all right? This is really a question. We could have the break now as well, but I would rather do the present values, future values now for completeness. But if you're burned out, we can have the break now. What is your opinion? Okay, let's do it now. Doesn't help me. Let's do the break now, or let's do the material now. All right. Yusuf Beyciğim, canımsın benim. Yes, thank you. Okay, yes, question first. Somebody has a question. Or question first is, do you have a question, or do you want me to address the question now? Okay, very good. So now we want to talk about properly this. This is, again, nothing new for you to learn. Sorry. Let me turn this off. My bad. And cool. We want to think of a timeline and the value of stuff over time, okay? This is not new. It's just this way of being able to say things is useful, okay? So here's our timeline. Time flies in this direction. We are at time 0. In the future, there's going to be time 1, and time 2, and time 3, and so on, okay? 0 is the present. So from where we are now, I can ask, how do I value things that are going to happen in the future, okay? So I could ask the following question. Let's say the interest rate is I, and let's say it's constant, okay? Per year, it's I%. If I have 1 lira here, okay, what is the value of this in period 1? What will this be, okay? This is a future value question. What is the future value of 1 lira that I lend today? That's right, it's 1 plus I, okay? What is the future value of 1 lira I lend today in period 2? What is that going to be then? Something is off there. So 1 lira, and in fact, once again, I only see, yes, exactly. Well done, right? Yes, you are right, but just so that I say 2, right? 1 lira will be 1 plus I lira, okay? 1 plus I liras will be 1 plus I times interest plus principal. So it's going to be 1 plus I squared, right? In period 3, it's going to be 1 plus, I cubed, and so on. These are the future values, okay? I could also ask the following question. Let's say you know the future value. This is a bond, right? The bond says, tomorrow I will pay you 1 lira. Now I ask the present value, okay? And these present value calculations are at the root of finance. Now I ask the present value of 1 lira that I'm going to get tomorrow, okay? What is the value of 1 lira that I'm going to get tomorrow, today? I is the interest rate. 1 minus I is the wrong answer, my friends. Yes, Mark Bey got it right this time. He does need parentheses there, but yes. Look, here's what I want you to see. Give it a thought, and you will see it immediately. This is always not as straightforward the first time you see it. But let me ask you this. If rather than having 1 lira here, okay, I had n liras, okay? What is the value of n liras a year from now? What is the future value of n liras? No, it is not, idiots. That's right. Now this is correct. Yes, very good. Do learn to use your parentheses, okay? Because I'm going to get my n liras back, plus I'm going to get I% interest on n liras, right? So this is going to be n times 1 plus I, okay? Very good. Are you good? Yeah. Of course, I know you will get it, right? It's just that it annoys me that you don't sit down to think for a second before giving an answer, all right? Good, cool. Now, here's the question I'm asking. How many liras today turns into 1 lira in the future? What should n be so that the future value is 1? And clearly, the answer isn't 1 minus I, right? Because 1 minus I times 1 plus I isn't 1. That's exactly right, okay? So the answer is 1 over 1 plus I, because when you multiply this with 1 plus I, you get 1, okay? This is how you do bond pricing. The bond promises you 1 next year at I% interest, the price of the bond is 1 over 1 plus I. If this bond were a 2-year discount bond, okay, so that it paid you 1 here, what would the present value be? Yes, I will do the recap, okay, but yes, you got it now, right? The price is going to be 1 over 1 plus I squared, okay? Since I is some positive number, the price of this bond is going to be less than the price of that bond. That means the yield curve will be upward sloping, okay? Is this correct? Is this correct? No, it is not, okay? You fell into a really easy trap. This yield curve is flat, okay, because the interest rate is always 1. My bad, always I. It's always the same I%, right? The only reason the price of this bond is lower is because it's I% for 2 years. It's not downward either. It's completely flat. By assumption, I told you that for all future horizons, the interest rate is I%. At 1 year, it's I%. At the second year, it's I% again. The average of the 2 years, I% again. Okay? This is yearly, okay? I is yearly. So between years, between the times 0 and 1, this is I% per year. This is yearly too. It's again the same I%. Okay? What is the average interest you're going to get for the 2 years? You're going to get I%. So on a yearly basis, the 1-year bond gives you I%. The 2-year bond also gives you I%. Why are the prices different? Because this one gives you I% for 1 year. This one gives you I% for 2 years. Are we good? Let me see a bit more yeses here, okay? Very good. Now, once again, a quick recap of the present value, future value idea. Present value is from the perspective of now. So I can ask you, what is the present value of a bond that pays you 1 lira here, 1 lira here, and 101 liras here, okay? And you would ask yourself, what is the present value of 1 lira here? Let me find that. What is the present value of 1 lira there? Let me find that. What is the present value of 101 liras here? Let me find that. Add those up, because this bond is telling me the sum of those. That's the price of the bond, okay? How would you do that? That's the present value idea. Essentially, this is how you relate bond prices to interest rates. Notice again that the following line of thinking is not exactly correct. The interest rate is 2%. This pays this much. In the future, what is the present value? Okay? It's wrong for the following reason. In general, these things are one and the same. There is no interest rate before there is the bond price. The bond price implies the interest rate. These things are simultaneously determined. Okay? When I ask you, how much will you pay to be paid 1,000 liras 6 months from now? You give me an answer. That answer is what creates the interest rate. Okay? But this is finance. So you think about a lot of different securities, a lot of different cash flows, a lot of different risk profiles. Okay? And think that along the lines of, okay, I see that this bond is being priced this way. Okay? And this other thing is now made available. If this one implies an interest rate of 4%, right? Well, this one, I can begin thinking by relating it to the other one that is already priced, right? But once again, I'm just trying to whet your appetite to learn a bit more finance, not for finance's sake. If you want to learn macroeconomics, you really have to know some finance as well. These things work together, all right? Especially for cyclical macro. For growth, somewhat less important, maybe. So we have present values, we have future values. We could also ask questions along the following, in the following vein. I could ask you at time 0, okay? Imagine that this is time 1 now, and you are being offered a security that pays off in time 2. At time 1, what present value will you assign to a payment in time 2? This is the forward rate idea. So these things are all possible. You don't have to know all of them. You don't have to know most of them, actually, for the purpose of this class. But now that I've got you, let me ask you another kind of interesting question. Remember our coupon bond, okay? And here I have coupons. And here I have a maturity, right? 26 March 2021. And this thing, let's say, pays 5% coupons, because why not? Here's the question. Can I make the maturity of this thing infinity? Would you buy it if I tried to sell you this bond that never pays the principal back, never pays the face value? Okay, as usual, there are yeses and nos. This one has a correct answer, and the correct answer is yes. Yes, you would buy it. Notice what I'm offering you. I'm offering you these coupon payments forever. Do they have value for you? If they have value for you, right? Can you find the present value of a sum of coupon payments that go on until infinity? Yes, right? And since this discount factor becomes essentially 0, right? Because at some point, you're looking into a coupon payment that I promised to make you in the year 3000, okay? And so this is 1 over 1 plus I to something like 1000. It's about 0, right? Coupon payments way out there have essentially 0 value. So this sum is going to be a convergent sum. This bond is going to have a finite price, okay? Do these things actually exist? Has anyone ever sold an infinite maturity bond? The answer is yes, my friends. Okay, and there is a name for them. This is general culture. They are called consoles or perpetuities. Perpetuity is a nice word for this. You may have listened to a perpetuum mobile, or you may have heard of the perpetual motion machines, things that go on forever. And a perpetuity is a security that pays off forever, okay? These are called, again, either consoles or perpetuities. As long as they have positive coupon rates, I can price these things, I can sell these things. And in fact, these things have been sold in the past. England issued these things in one of the wars with the continent some hundreds of years ago. You can look this up. And I gave this example yesterday, and I thought I would look it up afterwards, but I forgot. But you should. So Yale University owns one of these things from some little town somewhere either in the Netherlands or in Belgium. So these guys were, I think, were going to build a fountain or something of that sort for their town. And they issued this console, again, some hundreds of years ago. And Yale is still happily collecting on this. What it's paying is the equivalent of $1 a year, but for the fun of it. Notice that these are dangerous things to issue and to buy. Because today, let's say Turkey issues a 10% coupon perpetuity, okay? And that would be more or less it, because that's the inflation we have. Tomorrow, we get a decent central bank, and we get a strong disinflation, and inflation falls to 1%. You're still paying off these 10% coupons, right? So suddenly, the real coupon rate skyrockets because you thought those 10% coupons will be worth nothing two years down the road because of inflation. Once you disinflate, the real payments you make go through the roof, okay? Long-term issuance is actually tricky business. Why borrowers do it is an excellent question, borrowers do it because making these small coupon payments for a long time feels much easier than having to pay the 1,000 2 years down the road. So if you think that you're England, you're at war with France again, and you think that the France is going to go on forever, then to fund a war that will go on forever, you would much rather borrow at a maturity of forever. Okay? We can't make sure that the interest rate will be the same every year. Okay? I gave you that example for simplicity. But in general, we have expectations that the interest rate itself will be changing over time. Good? All right. Very good. So let's have a break. I'll pause this recording. And let's say 5 to noon, we get started again. All right? Get your teas, stretch your legs, and we'll be back. See you in a few minutes. And welcome back. Somebody during the break asked the difference between a console and a discount bond. It is very different. In fact, they are as different as it can get because the console is a promise for an infinity of future payments. It's going to keep on paying coupons forever. A discount bond is a promise for a single future payment. It is only going to pay its face value on the maturity date. Now, a discount bond, something of this sort, okay, 1,000 on whatever date, we also call it a zero coupon bond, as well as a discount bond, right? And you can immediately see that if this thing had 0% coupons, it will only pay the principal, and it will be a discount bond, okay? This language of principal isn't very good. Properly, one should call this the face value. Principal usually is in a bank loan. You are lent the principal, and then you pay principal and interest back. But people sometimes use principal for this too. Properly, it pays the face value, the notional amount. Now, let me ask you this. We agree that you would assign a price and at the right price buy a console, okay? Would you buy a zero coupon console? Very good, smart people. The answer is no, okay? And we usually use this between economists as a joking matter. We call someone an idiot. You could say, yeah, the guy would buy a zero coupon console. Why? Because a zero coupon console essentially says, I'm not going to make you coupon payments. And I promise you the principal payment at infinity. Would you buy this? Right? Essentially, to get payments never, how much would you pay today? And that one has a correct answer. It's zero. All right? Yes. Very good. Okay. So now we're going to switch to thinking of central banks and central banking. And there, our question is going to be, we had already talked about the creation of central banks as, in a sense, bankers' associations. Banks themselves came together and created a central reserve in many countries to work as a lender of last resort. Let's get rid of these and use the word to talk about central banking. A lender of last resort is the institution that banks turn to if they can't borrow from each other. There is an interbank market, bankalar arası para piyasası. In the interbank market, banks lend and borrow with each other. But if I'm a bank that at the end of the day have liquidity needs and couldn't borrow from anybody else, I need to turn to someone, and that someone is the central bank. For that reason, central banks are known as the lenders of last resort. Bunun Türkçesi herhalde son çare borç vericisi gibi bir şey. Right? And of course, in the current world, in the world with fiat money, paper money that is unbacked, central banks can do unlimited amounts of this. Because in the olden days, the central bank could only lend you as much gold as it had. But now, the central bank, if it's needed, can just push a button and print more money, create more money. Okay? Here's the question though. Let's say I'm a central bank. Let's say you're all banks, and I'm the central bank, and we're thinking, how is it that you're not? I'm thinking, okay, I want to increase the money supply. I want to increase the amount of money in circulation. I want these banks to have more money. The first thing I do is to create the money. So I print it. We have the printing press in Ankara, Beşevler, right? And you see these people, if you watch the evening news, which are not worth watching, but if you do, you will see that before they switch from political news and cats that are rescued by firefighters from treetops, whatever, to the economic news, they usually show this little clip where oftentimes you see these people turning over huge sheets in a book-like thing of money. That they run their hand over that sheet, turn it over, run their hand over the sheet, run their hand over the sheet, look over. What they're doing is they're checking newly printed money. These are central bank employees, okay? And that is exactly how the central bank creates money. It requires some ink, some paper, some security measures. But here I printed the money, I have the money here. Right? Notice that as long as the central bank has the money, from your perspective, whether the money is printed or not makes no difference. You don't have access to this money. It's not money in circulation. I haven't increased money supply yet. I have to get this to you somehow. And the question is, how would I do that? Option one is giving you money. Can I do this? Sure, yes, you will be happy. Okay, stop it. I know, yes. When somebody comes and can I give you money, right? You will say yes, and there's nothing wrong with that. Except if it's the central bank doing this, there are at least two things wrong with it. One is the mechanics of that, right? How do I do it? Who do I give it to? Do I go out in Ulus in front of the central bank, assuming this is where the central bank is now, because our central bank stupidly moved half of itself to Istanbul, and it's this completely broken institution now, right? And they don't even know physically where they are located. But let's say legally they are an Ankara institution, as this is the capital, and central bank's charter said it's a Ankara institution. You go out in front of Ankara, Ulus, the central bank building. I get my newly minted money here, and I say, yo, here's money, would you like some, right? People are running towards me, and I'm just trying to give them money. And you can immediately see that it doesn't work all that well. I will probably be, trampled by this. And more importantly, okay, we're all people in Ankara, we love our Ankaralılar, whatever, but what is so special about the people who happen to be near the central bank at that time? Why am I giving them the money? This is a problem we could solve. Maybe I will just electronically wire transfer 1,000 liras to everybody's bank account. Then you would ask, but what about the people without bank accounts? And in fact, it's those people probably who want that money the most, okay? But let's say we found a way. Let's say we found an equitable way that made you all happy of giving you some amount of money, okay? You happy now? Fine, good. Did I increase the money supply? Is there more physical money in circulation now? Yes, okay, I'm happy now. Except if I'm a, positive IQ central banker, I have to be thinking, well, this operation has to be working both ways, right? Today I want to increase the money supply. Tomorrow I may want to decrease it. I may want to take money back to the central bank. How do I do that in this case? Do they go out? Do I go out with a large stick in my hand, right? Hit you on the head, take your money from your wallet, and reduce the money supply? Okay, so somebody said increasing taxes. Understand the division of labor here. Central banks do not work with taxation. It's the government, it's the treasury, it's the finance ministry that does taxes, okay? Central bank is with money only. The problem is I know how to print money and get it out, I thought, but I suddenly realized that this way of dumping money on people works only in one direction. People are very happy to be dumped money on, but if I say, now I'm gonna undump the money, give me the money back, will you give the money back? Okay, so now you understand. So this way, this is a thought experiment that goes back to Milton Friedman. How would we increase money supply? Okay, this is called the helicopter drop of money. I go up in a helicopter with bags of money, I dump them down, it rains on you, right? This is what you dreamed of all your life, everybody's happy. Fine. The helicopter drop is something that would work in the drop direction, but it would not work in the lift direction. I can't get money out, okay? So what I would do is, rather than dumping money on you, I will buy something from you and give money to you in return. And when I want to lower the money supply, I will sell it back and take the money from you. Would that work? Sure. Then the question becomes, what is it that I will buy and sell? How about uskumru? Uskumru is what? Mackerel, okay? Fish. Could I buy your fish and give you money in return? Yeah, I see that you've already gotten the idea, but allow me to build up to it so that you would see why the answer is that, okay? Yes, I could buy your fish. The problem would be a year later, I now want to reduce the money supply. How about you people buying year-old fish? How happy are you to do that? Or what is the price? Yeah, that open market operation, that's what it's called, doesn't work all that well because the thing I'm selling must be something of value. And the thing that I'm buying and selling must keep its value somewhat so that I can work with this both ways, okay? So I could buy bow ties. Here we are, okay? Can I buy bow ties and sell them a year later? Sure. You can see that this is going to be a very clumsy way of doing things. Among many other problems, if the central bank comes in and says, okay, I want to buy 1 billion liras worth of bow ties to increase the money supply by 1 billion liras, the bow tie prices will go through the roof. And I will be upset. I'm a consumer of bow ties. Okay? And in fact, the bow tie producers will be very happy because their good is now facing insane demand from the central bank. But what is wrong with shirt makers? Why buy bow ties and not shirts? Why are you changing the relative price of the bow ties? What is so special about bow ties anyway, other than the fact that I'm wearing them? Okay? You can't justify this. The right way, and what happens if you want to sell the bow ties and people say, yeah, bow ties, those were last year's fashion, no good anymore. Okay? You want to do this with things that are liquid and that will be liquid, with things that will have some value, and with things you can defend with a straight face, sure, I am dealing with these things. I am the central bank, okay? Usually those are financial securities. So somebody here suggested you buy stocks. The problem with stocks is stocks are shares of private firms. The owners of those stocks are shareholders, hissedar. You are an owner of that firm. Do you want your central bank to own the private firms? Should it? There you go, okay? Better to do this with, and in fact, of course, what happens if the firm goes bankrupt? I bought into this firm as the central bank, and the firm went bankrupt, and I have the stocks, they are worth nothing. How do I decrease the money supply now? How do I justify that financial investment decision? Okay, I have to deal with someone which is not going to make anyone question why that entity's stocks, why that entity's bonds. That is the government bond, okay? Because I, as a institution of the I, as an institution of the government, the central bank, am buying bonds of the government itself, okay? This is clearly justifiable as a tool of monetary policy. So the central bank, when it's doing what is called open market operations, buys and sells government bonds. Okay? If the central bank wants to increase the money supply, is it going to buy bonds or sell bonds? Exactly right. It's going to buy bonds, right? Because I will be buying your bonds and I will be giving you the newly printed money, which is how I increase the money supply. Okay? If I want to decrease the money supply, do I buy bonds or sell bonds? Yeah, it's symmetric, right? Then I sell bonds, take your money, cool, excellent. Notice what happens though. As I increase the money supply, there is more money out there. Money is what we lend and borrow. If there is more money, are the interest rate, is the price of that money, is the interest rate going to go up or down? Yeah. Notice this works exactly the right way in the bond market too. The central bank comes in and says, I want to buy a shitload of bonds because I'm going to increase the money supply a lot. Okay? What happens to the price of bonds when somebody comes in and says, I want to buy a lot of bonds? Exactly. Bond prices will go up. What happens to the interest rates when the bond prices go up? And interest rates fall. Okay? Very good. So now you understand. Now you properly understand. Okay. So that's very good. Now this is where we begin to think about the amount of money out there a little bit better. Okay? This is where banks are going to come into play again. In the following sense, when I ask, how much money is there? This is a well-defined question. How much money is there in terms of Turkish liras that the central bank has created? Okay? How much money is there in circulation? How much money is there that can be used? Now, this is a very good question, right? How much money is there that if people freak out, they can use to buy foreign currency? If there is a run on the lira, people want to get rid of their liras and buy foreign currency, okay? How many liras do they have to buy foreign currency with? The Fed doesn't buy stocks right now, no. The Fed is buying non-government bonds, but not stocks. All right, good. Let me go back to my monetary aggregates question, okay? This is a question of monetary aggregates. How much money is there, okay? The narrowest way you can interpret this question is how much money has the central bank printed? How much money has the central bank made electronically available? But how much money has the central bank itself created? Okay? That thing, the money that the central bank has created, is known as base money, okay? Or high-powered money. Para tabanı. And you're going to see in a second why it's called high-powered, what is so high-powered about it. Okay? Because here's the question. Let's say you have a demand deposit at bank. Vadesiz mevduat. Is that sufficiently money for you? Do you feel like money in your pocket and money in your bank in the demand deposit are essentially the same money? Okay, so Sana Hanım, as usual, is the exception, but you have converged on a almost unanimity, -1, of yes, money in the bank, money in my pocket, it's both money, okay? In fact, it is true that you live as if you have money in your pocket when you have money in the bank, okay? Fine, sure, cash, but here's what I want to say. Money in your bank is very much like cash in the sense that you can go to an ATM anytime and withdraw it. So how is it different if it's in your pocket actually or at the bank? It is true that depending on who you are, how you live, what you feel about these things, you may not think of this, as economists, this is a term we're going to use, you may not think of these as perfect substitutes. But for most people, they are almost perfect substitutes. And observationally, people who have money in their banks behave the same way as people who have money in their pockets. If you want to buy something, you can use your money in the bank, even more so now, right? You don't even have to withdraw it. If you want to make a payment to someone, you can make an electronic payment so that money never leaves the bank, but it has used, or I have used it as the means of payment, right? It was very liquid, okay? So I then think, well, if money in the bank, demand deposits are essentially perfect substitutes for physical money, then these are both money. And I'm going to think of a monetary aggregate. I'm going to call it M1, that is base money plus demand deposits, okay? If you go to the central bank webpage, you can find these numbers. M1 is a narrow money definition. Slightly wider definition, which is more often used, is M2, which is where I say, what if you have non-demand deposits, but time deposits, vadeli mevduat, at the bank? Can you get that money out of the bank immediately as well, okay? Is that sufficiently liquid? Is that deposits sufficiently easily convertible to money and therefore behaves as money, okay? The answer is, okay, not as easy as demand deposit. Why? Because time deposits have a maturity and they pay interest at maturity. If you take it out of the bank before then, you forfeit the interest. You only get what you put in. Essentially, it turns into a demand deposit, okay? But can you get the money out quickly? I'll wait for a few more people. If you have a time deposit, can you go to the bank and say, it's not the maturity date yet, but I want my money now? Can you do that? The answer is yes, okay? It remains your money and you don't have to wait until the maturity, right? That is why, once again, and it's unlikely that you will have time deposits, but time deposits at times of need quickly turn into demand deposits. Demand deposits are money, time deposits are almost money as well, okay? So a slightly wider definition of money, M2, is M1 plus time deposits. My handwriting, even by my standards, has gone haywire there. Okay? And this is the usual measure of money. When we think of how much money is there out there, we usually think of M2. And we think of the relationship between M0, that is base money, and M2. If you read the definitions, and I encourage you to do so, you're going to find lots of documentation on the webpage. You can see the time series of these things. And you're going to see that there are other junk in there. You know, it's this plus that plus this minor thing, whatever, whatever. But more or less, it's these. And to have the right idea, this is what you need to know. Now, an important issue here is thinking about the ratio of base money to M2, for example. how do we end up with more money than we printed? Okay? And that's the process of what is called the money multiplier, para çarpanı. Let's talk about that, okay? How does this base money get transformed into M2? Let's erase this and go back to thinking about how banks work, right? Remember that banks have balance sheets that look like this, right? They have liabilities, they have assets, they have capital. They can use this capital and also deposits and also other loans, right? These are called non-core liabilities. Core liabilities of banks, the business reason of the existence reason of the banks is to have these deposits. These are core liabilities. Other liabilities are non-core liabilities. Like what? Like a Turkish bank goes to a German bank and takes a wholesale loan from that bank or sells a bond to that bank, okay? In which case, you're going to have liabilities here. These are not deposits. These are not deposits, but you have raised funding. What do you do with that funding? Let's say I did all of these, okay? And I'm keeping them. I have a boatload of cash. Cash for banks are reserves, right? The bank has reserves. Now, this is a stupid bank because you put in your own capital as the banker, right? You raised deposits, you took loans, and you're just keeping them as reserves. There's no point in doing this. So you're going to do the fundamental banking thing, and you're going to find good borrowers, and you're going to lend to them, right? So some of these reserves are going to be bank loans here, okay? These are things that we already talked about when we were doing class in class. So just a reminder, are we good? Cool. Now I could go crazy and lend all of these. I could bring reserves to zero and lend all out, right? But that means that the moment my first depositor comes to me and says, oh, I was going to buy chewing gum, so I'd like to withdraw 1 lira, I'm going to go bankrupt. I will have to say, I don't have the liquidity. I'm a solvent bank, but since I'm so liquid, I'm going to go bankrupt, right? To make sure that this doesn't happen, many countries, not all countries, many countries have regulations, including Turkey, that says you have to hold a certain fraction of your deposits as reserves. Those are called required reserves. Türkçesi muzam karşılık, şimdiki Türkçesi zorunlu karşılık. You have to hold some of your deposits as reserves, a certain fraction, right? That fraction is a small number. In general, it's something like 3%, 5%, 6% of your deposits, okay? So it's not like you have to hold 30% of deposits as reserves. And that system works because you have the central bank to backstop. Now, notice though, what happens when the central bank does open market operations? We understand from the definition that these banks also hold bonds, okay? In fact, in the olden days, in the 80s or so, I forget when this was lifted, but Turkish banks were legally required to hold a certain amount in reserves and a certain amount in bonds. They had to hold government bonds. Bunu böyle büyüklerinizle konuşursanız, bunları bilen, düşünmüş olan insanlarla disponibilite derseniz eğer, disponibilite, gözleri dolar. Okay? They had to hold bonds too. Now, they still hold bonds because it's good investment, and not all banks, but some banks are primary dealers. This is not language you have to know, but this is language you should know. This is how this market actually works. The central bank, when it's going to, let's say, increase money supply and it wants to buy bonds, right? Have you ever heard, oh yes, the central bank is holding an auction. let's go and sell our bonds too. It doesn't happen to you or me, okay? It deals with banks. And it doesn't deal with all of the banks, but it's with some of the banks. Those some of the banks are primary dealers. Those are the ones that the central bank does open market operations with, okay? So the central bank says, this morning, usually in the mornings, this morning, I will buy so many liras worth of bonds, okay? At what price would you sell these bonds to me? And of course, it buys the cheapest ones and gives money in return, right? So here I had a bank that used to hold bonds and reserves and loans, okay? The reserves was what constrained the size of the bank, because my deposits can only be a certain multiple of the reserves because of the reserve requirement. Okay? Now is a good time for me to ask, are you with me? Okay, cool. Thank you. What happens when I increase the money supply? I bought your bonds. In return, I give you more money. Now you have more reserves and the same amount of deposits. You didn't have to hold this much reserves. So what are you going to do? You're going to lend it out. Okay? When you lend it out, what is going to happen? I am a bank. I got 1 lira by selling my bond. Okay? And that 1 lira that was completely an excess reserve, I lent it to you. All right? Now, let's say I lent it to Doruk Bey. Doruk Bey has 1 lira. And when asked, how much money do you have? He's going to say, I have 1 lira. Okay? Why did he borrow? Because he wanted to buy chewing gum. So he went to Can Bey, bought his chewing gum, gave him 1 lira. Okay? Now Can Bey has 1 lira. The money supply has increased still by 1 lira, right? But Can Bey has nothing to do with that 1 lira. So he puts it in the bank. In the end, money comes back to the bank. Now, Can Bey has a 1 lira bank deposit. Of that 1 lira, the bank has to hold a certain amount as reserves. Okay? Let's call it a fraction RR, required reserves fraction. And it's going to lend out 1 minus RR, right? So the money supply increased by 1 because Can Bey thinks that he has 1 lira. Okay? Plus, the bank is going to give a loan of 1 minus RR. That 1 minus RR is going to come back to the banking system as deposits. Somebody else is going to be thinking, I have 1 minus RR liras of bank deposits. I have 1 minus RR liras, right? Of that, another fraction 1 minus RR, 1 minus RR of 1 minus RR is going to come back, is going to be lent out and come back to the banking system. So it's going to be 1 minus RR times 1 minus RR, right? That's going to circle back in, and that's going to be minus RR cubed, and so on, okay? This is how the new money circulates in the banking system. It comes in as a deposit, goes out as a loan, comes in as a deposit, goes out as a loan, but every time the loan is less than the deposit amount because banks keep some of this as reserves, okay? And now you see the multiplier process here, very much like the GDP multiplier we talked about earlier. And once again, right, this is a sum that goes from 0 to infinity of 1 minus RR to I. And since this number is less than 1, this is a convergent sum, which converges to 1 minus RR, 1 over RR. Since this number is, if it's 5%, RR is 0.05. So that number is greater than 1. It tells you why M1 and M2 are larger than the high-powered money. And it also tells you why high-powered money is high-powered, okay? Because 1 lira of base money has the power to create more than 1 lira of money, as much as this much, okay? Questions on this? Fairly straightforward, okay? This is called money creation by banks. And now you understand why it's called that. Since bank deposits are money, okay? and people who receive loans have money, right? Banks, by able to, it's not the loan making function, it's the deposit making function that makes banks create money, okay? Because I can give you a loan too, but if I give you a loan, I no longer have the money. But if I give it to the bank as a deposit, I feel like it is my money still, okay? So a bank makes a loan. Yeah, okay. So whether less reserve requirement is better for the country is a not so obvious question, because it's not clear that you need the lower reserve requirement to have more money. Creating more money, more high-powered money, is free for the central bank. The cost of creating money is essentially zero. So if you want to have more money, you can just print more money rather than having a lower reserve requirement, because a lower reserve requirement makes your banks more risky, and that might not be a very good thing. Okay? We call high-powered money high-powered because high-powered money is one more lira of bank reserves that the central bank creates. If you have one more lira of reserves, it begins to circulate and turns into more than 1 lira of money supply. That's why it's high-powered. All right? So now you understand that central banks are able to change the interest rate. And something I really want you to understand is, although I said the interest rate for the purposes of the way we think of the world in 102, because we talked about the yield curve and maturities and different things, you know that there are many interest rates. The central bank is able to control only one of them. The central bank controls the interest rate in the interbank market, the short-term interest rate in the interbank market. In the US, this is the overnight rate. In Turkey, our central bank targets a 1-week rate. It has an administrative rate of a one-week repo rate. And essentially what it does is it says, okay, I'm going to look at the interbank market and I'm going to do open market operations to change the amount of money available there so that when these banks are transacting with each other, they will be using an interest rate that is close to my policy rate, okay? I want you to understand that you do this with the aim of affecting longer term interest rates. I'm going to make more money available in the interbank market. I'm going to lower the interest rates in the interbank market, and the banks are going to lend at lower interest rates to businesses, to households at 2-year, 4-year, 5-year horizons, okay? Depending on how you do things, what kind of a central bank, what kind of a country you are, this might work. But notice that the following can also happen. Your central bank comes in and says, oh, yes, I was targeting 5% inflation. Inflation is 12%, and I'm lowering interest rates. I'm going to make more money available. If your banks and your public thinks that, this is going to lead to much higher inflation in the future. Therefore, much higher interest rates in the future. Long-term interest rates will not go down. They will go up. This is something that actually happens in Turkey. And this is the sad state of policymaking in Turkey. All right? I do want you to know that this idea of open market operations is very useful, but this isn't the normal policy framework of central banks anymore. That is, you don't hear central banks in normal times coming out and having a press release saying, in today's policy meeting, we decided to increase the money supply by 3%. What you hear is we decided to lower interest rates by 50 basis points. Central banks understand that what matters isn't the amount of money, it's the interest rate. And they directly tell you what they're going to do with the interest rate. Except in times of acute liquidity crises, what begins to matter is actually the amount of money. And now, therefore, you see the central banks like the Fed, the ECB, Bank of Japan, making announcements on money supply directly. We're going to buy so many billions of dollars worth of bonds, private sector bonds and government bonds. Okay? Why is that? Because if the problem is liquidity, you don't solve liquidity problems by the price of money. It's really the amount of money that matters. So the central banks say, we're going to increase the amount of money by this much. All right? Good. Now, this is our last lecture together for a few weeks. We're going to have Burçin Hoca. Burçin Hoca is I'm happy to say, better economist and a much more competent teacher than I am. It's unfortunate that you haven't met him in person in the classroom, but I'm sure you're going to be, well, you are yourselves still, so you will be interested in learning economics. Please show the same enthusiasm that you have shown in this class, in being active in chat, asking questions, responding to questions, so that she, like me, gets this feeling that we're working with a large group of brilliant people. We're lucky to have you as Bilkent students, and we're lucky to have you as interested in this material. Obviously, we're economists, and this is our life. So we are excited about this. And it's very rewarding to teach you when you are as excited as you were today and in our Tuesday class. So I'm very grateful. Until we are back together, be well, be good students. We're going to send you homework. Make sure you work on those things. We're going to find a way of giving you an exam. Please pay attention to those things. But most of all, be safe, be healthy, don't leave home. And if you need anything, this remains your department. Let me know. I love you all. Take care. And we'll be back together. Goodbye.